landscape. There are ongoing legislative efforts aimed at clarifying digital asset frameworks. The Clarity Act discussions, stablecoin yield debates, and regulatory coordination between banking institutions and crypto firms all represent structural evolution. When regulation moves from hostility to negotiation, the market transitions from fear to pricing future adoption. That does not happen overnight. But markets are forward-looking mechanisms. They price direction before headlines. If progress emerges on regulatory clarity, capital flows adjust quickly. Which brings us to why this matters for crypto as a whole. Crypto is no longer purely retail-driven speculation. That was 2017. Today, we have institutional allocators, hedge funds, family offices, public companies, ETF structures, custodial frameworks, prime brokerage support. Liquidity flows through larger pipes now. That changes volatility dynamics. The swings still exist. Manipulation still exists. Emotion still exists. But the structural foundation is more mature. And when macro liquidity turns supportive in a more mature market structure, the upside talk can be powerful. Not because of hype, but because capital has somewhere legitimate to flow. We are watching an asset class transition from fringe to financial plumbing, and XRP sits directly at the center of that transition narrative. Let's dig deeper into that. XRP is not merely a speculative token. It exists within a broader conversation about cross-border settlement, tokenized liquidity, and institutional payment rails. While Bitcoin acts as a macro liquidity barometer, XRP's value proposition ties into utility, network integration, and regulatory clarity. So if Bitcoin has likely formed a macro bottom due to liquidity dynamics, what does that imply for XRP? It suggests that the systemic drag weighing on the entire asset class is easing. When macro pressure recedes, assets with strong narratives and improving regulatory positioning tend to outperform. But let's be realistic. Short term, XRP may continue to trade within a range. Consolidation zones often frustrate investors. They feel stagnant, they feel heavy, they feel indecisive. Yet ranges serve a purpose. They build cause for future moves. Every week that XRP holds above prior panic lows while macro liquidity improves, increases the probability that the next major move resolves higher rather than lower. Now let's talk about institutions. Institutional capital does not chase emotion. It waits for structural confirmation. Liquidity pivot, check. Regulatory progress, developing. Market maturity, improving. Infrastructure, expanding. Institutions allocate when asymmetry is visible. And right now, the asymmetry is quietly shifting. During tightening cycles, institutions reduce risk. During easing cycles, they expand exposure. The Federal Reserve's balance sheet trajectory matters more than social media sentiment. If global liquidity accelerates through the second half of the year, capital will search for performance, equities will capture some of it, emerging markets will capture some of it, and crypto, as a high beta liquidity asset, will capture a disproportionate share. XRP's institutional angle becomes particularly interesting in that context. Cross-border settlement efficiency is not a retail narrative. It is an enterprise narrative. Tokenization of real-world assets is not a meme cycle. It is a balance sheet evolution. Stablecoin infrastructure is not speculative fluff. It is the digital extension of dollar dominance. If regulatory clarity aligns with liquidity expansion, XRP's positioning strengthens considerably. Now let's address regulation more directly. Regulatory uncertainty has acted as a ceiling on valuation multiples across many digital assets. When uncertainty declines, multiples expand even before earnings or utility metrics materially change. The Clarity Act discussions signal that policymakers are increasingly forced to define rather than suppress. That shift matters. Markets price clarity aggressively. Even incremental progress reduces risk premiums. And reduced risk premiums increase asset valuations.